المرة اللي فاتت حكينا بالارithmetic والجيومتريك ميثودز وحكينا بالستاندرد ديفيجن والريسك and how we evaluate risk. Today I'm going to talk about the efficient market hypothesis. What it means, efficient market hypothesis, means that the information, all available information should be incorporated in the price. Okay? So this is the efficient market hypothesis. If the price fails to reflect the available information, it means the market is inefficient. The question is, what is the information? We can categorize information into three main categories. The first one, the historical information. The second is public information or fundamental information. The third one is the private information. To the extent that the market reflects this information, considered as a strong market, semi-strong market, or weak market. Generally speaking, in the efficient market hypothesis, people or investors cannot get abnormal rates of return because the efficient market treated people fairly, and the return is equal the risk. We have two different point of views. Some of the empirical finance find that the market is efficient. Others, they find that the market is not efficient. I think from my point of view, there's no problems between the two arguments, whether the market is efficient or the market is inefficient. Generally speaking, for the financial markets, it could be inefficient in the short run. In the short run, I mean, in the very short term, let's see, less than 1 year, or in a particular days or in a particular months, so we can claim that the market is inefficient. But in the long run, if we talk about the long run, in the long run, the market is efficient. So this is the idea of the efficient market hypothesis. And so again, we have the weak market, and we have the semi-strong market and the strong markets. And the main idea of this categorization based on the information or the available information. The weak form efficient market assert that all of past security market information is fully reflected in the stock prices. So in weak market, the weak markets only reflect the historical prices. This means that all price and volume, the price, I mean the stock price, and volume is the trading volume, is already reflected in securities. For instance, if you have the time series, this is a time series this is a time, say days, and this is the price. These are the price. If anyone analyze the prices and the trading volume as well, he or she cannot get benefit from this analysis because these are historical prices. Okay, and this is why if the investors consider the analysis or put much time on understanding the analysis, they cannot get benefit from this analysis because it's already in already reflected in the financial market, particularly in the weak form efficient markets. If we look at the semi-strong market, the semi-strong market reflects, in addition to the historical market, the historical data, it reflects the fundamental data, fundamental or publicly available data. The fundamental data include the financial data, accounting data, economic data related to a particular company. So if the investors come up with a bunch of data and analyze these data, they cannot get benefit from doing this. But let's go back to the semi-strong. But if the investors go back to the weak market. In the weak market, if the people analyze the fundamental data, they can get benefit. Okay, but vice versa, if they do it in semi-strong market, they cannot get benefits, because in the weak market is only reflected the historical data. But for the fundamental data and the historical data is reflected in the semi-strong markets. Okay, so this is the idea of semi-strong markets. For the strong markets, strong market reflect the historical data, fundamental data, and private data. So 3 different types of data are reflected in the price. And what it means, private data, in private data, it means the information that the information related to the inventory of the stocks. This is the private information, and this is only available to the insider traders and the some speculators or some institutional investors. In this level, we don't need to go in depth on understanding who are the insider traders, but in the investment course, it details who are the insiders. But generally speaking, private information is the information related to the insider trading. For instance, just to give you example about the private information. See, for instance, this is the financial markets. Here are the traders here, and the financial market is in here. There is no direct contact between the investors with the financial markets. Here there are speculators. The speculators here, they have inventory. Let's see, this is the inventory. Let's say this inventory for IBM. Okay? Now, the speculator only knows what is the level, the acceptable level of the inventory of stocks. I mean, stocks inventory. Okay? Now, let's see some of the dealers asking to buy IBM. The IBM here, the inventory of IBM should be in this level. Should be in this level. Now, it is in this level. Now, the more buyer of the stocks will make this line to go down. Okay? To be close to the preferable line of the inventory. Now, if it becomes close to this, so the speculator tried to make the price to go up to prevent additional buyers. Okay? So, who knows the inventory? Only the insiders know the inventory. We don't need to talk about this in details, but this is the idea of private information. We don't mean the private information is like some policies or some strategies of the business. Okay, because these are fundamental information related to the announcements of this. And the hypothesis of the strong market form, the information related to a particular company is unexpected, and the announcement is not expected. Nobody can expect what is the new announcement or what is the information. This market, the strong market hypothesis, reflect the historical information, reflect the fundamental information, and reflect the private information. But the question is, do we have strong form hypothesis or not? Or do we think the market is 100% efficient or not? This is a big question. Generally speaking, the market is partially efficient. It's not 100% efficient. So why? Because there are some influences make the price to deviate from its origins, and there is some misprice in the market, and the misprice considered as inefficient. In general, markets are expected to be at least weak form and semi-strong form efficient. This is at least. But if we want to talk about the strong market hypothesis, we have arguments around this issue. If there did exist simple profitable strategies, then the strategies would attract attention of investors who, by implementing the strategies, would compete away the profits. For instance, if the market efficient, it doesn't mean the market is 100% efficient. We consider that the market, if the market is efficient, so all of the stock located in the security market line, all of the stock. But sometimes the risk and return relationship is not going well. Sometimes this relationship deviates from its intrinsic value or intrinsic line. So the institutional investors try to keep this deviation to its origin. Okay, I know this is very complicated for your head, but this is the idea of the what I mean. If the return, if the relationship between the risk and return is not going well, I mean, this is the risk, and this is the return for this stock, and it should be here, not it should be in this area.
Yeah.
So the market mechanisms try to push this stock up to be in its origin. So this is mispriced. This area known as mispriced. And if we have misprice, it means the market is inefficient. But the market is inefficient in a particular seconds, just 2-3 seconds. But in the long run, the market is efficient. So this is why the people who won the Nobel Prize, we have two different arguments. The Schiller said the market is not efficient. The Ogin Fama said the market is efficient. So we have two different arguments. But in the middle, both people are right in the terms of the short run and long run. In the short run, in particular second, the market is not efficient. But if we talk about the long run, the market is efficient. Okay? So I think this is what we should say. We would not expect financial markets to be strong form efficient. We expect that the market to be partially efficient, but not perfectly. There is no perfect. Just Allah is perfect. Reflect information that is privately collected. Even if we have private information, and this information may reflect after a period of time. Let's say, for instance, why we say this, if we are in here and we have a new information, we have a new announcement, a new information. Now we are at time t, and the information is at time, let's say at time 1. In this case, the new information should not influence on the stock return. But what may happen, because of the new information, may the prices or the stock return is deviate around the intrinsic value. Then if it is deviate to the bottom, it's after a while, 5 seconds, it go to its origin, or if it deviate to the top, after a while, it go down to its origin. So it's just inefficient. So because of this issue, the people, particularly the specialists observing this, and they try to invest their money in the mispriced securities. Why they invest? Because in mispriced they get higher return. This is the first. The second thing is to keep the price on its origin. So they try to correct the markets. So they observe where is the mispricing. If there is a mispricing, they intervene in the market first to get higher return, second to correct the market. So they make the market to be balanced. This is why in the short run we have inefficient, in the long run we have efficient. The markets will be inefficient enough to provide some investors with an opportunity to recoup their cost of obtaining information because they have particular information, but not so inefficient. There is easy money to be made in the stock markets. Efficient market hypothesis is based on the assumption that investors as a group are pretty rational. This view has been challenged. We not consider, according to last theories in financial markets, the fundamental theory of the financial markets, which supported by Eugene Fama, said the market is efficient because the investors are rational. Okay? The investors are rational. But in reality, according to the behavioral view, the investors are not rational, irrational. Because if you have information, and this information is right and correct, some people, they have different interpretations to this information. For instance, if the company decide to pay out dividends, and these people know that tomorrow or now, the market or today, it's announced this company will pay out. This is fine. Some people, they interpret this in different ways. Some people say it is not worth. It may not reflect in the market. Maybe this is paid from the retained earnings from the previous years and so on. So different peoples with different interpretations. What if investors are not rational? Investors are not rational if they have different interpretations. Okay? So if I give you ask me about your exam or your quiz, I say fine. What it means fine? Some people say fine. They have different misinterpretations. Fine to you is different fine to you and other people. So things depends on to what extent you understand this information. And we agree that people, they have different interpretations, depend on your psychology, depend on their understanding. And this leads us to talk about the behavioral view. There's a pretty example here. If we have a group of birds, okay, let's see, hawks, falcons, okay, falcons. ايش معنى الفالكون؟
بيحكوا عن الرسمة.
سمك بيردز. يعني ايش نعمل لكم اياها هيك؟ anyway. ايش عندنا الصقور ولا ايش بدكم انتم؟ بغض النظر we have المهم في عندنا مجموعة صقور مثلا وفي عندنا طير هان. شوفوا المس انتربريتيشن. وفي عندنا هان طير فهو he observing this group. Then هذا في different kind يعني نوع آخر يعني نفترض إنه هو كان نسر مثلا أو نفترض إنه حمامة مثلا بس أكيد راح ياكلوها. And some people observing people think هدول هم صقور. And if this guy joined this group, they think this guy also صقر. But in reality, it's not. So it doesn't mean that the company announced dividends. It is a good company.
Yep.
Okay? So this is the idea. It doesn't mean this guy joined this group is strong. So what's exactly going in the financial markets? If we have a good student sitting in this area, for instance, and we know this student sitting in this area, and if another student sit with them, maybe people think, oh, all of these students are strong. But in reality, not. So what exactly going? If in your exam, people writing and they are busy in answering the question, it doesn't mean people they understand what they are doing. So yes, this is the idea of misinterpretations. Don't think people put their heads and dry things, doing busy and sweating. Okay, it doesn't mean that they are working hard. It means yes. So some people, when I observe this, I'm irrational if I think that people busy on doing right things, they are doing right things. Maybe they are not doing the right things because I observe this. Let's talk about the financial markets. If you observe some investors taking decisions, and you know these investors are wealthy investors, and you are observing them because you have assumption they are wealthy investors. They have a prestigious car, they have Mercedes-Benz, they have things like this. Then if you observe them, you think they are taking the right decision. Then you try to copy them. You try to join them, and then what's happened? You are irrational because you have to know maybe these people not taking the right decision. And this lead us to talk about the herd theory. Herd. This is herd. The herd theory, نظرية القطيع. نظرية القطيع بتقول إنه هدول are strong, but it doesn't mean all of them are strong or is strong. And you join them because I'm strong because I'm with this guy, but generally not. Maybe this يعني إذا واحد بيتخذ قرار صح هو إيش اللي بيصير؟ هو موجود واحد هان he's the leader and all of them are following him. Then the guy is sitting, they are following him. Then he or she follow this group. But it's like copying them. Okay? But it means this guy is rational maybe, but these guys are not rational. Okay? Yeah. One of them could be doing right things in the exam and others not. So the assumptions again, some investors are not rational. If investors don't rationally process information, so I should go through the student and see how they use their calculators, and then, yes, they are doing well. Or if not, they are not doing well. And this is the new things coming to finance, is behavioral finance, which is new things and very complicated because it's intervened in your psychology. Then markets may not accurately reflect even public information because people have different misinterpretations. For example, overconfidence investors, we have some overconfidence investors or students. If I give them very simple question, they may get wrong answers because they don't think our teacher gave us like this question. So he or she think this is very complicated and try to treat the questions in this way. So again, overconfidence investors may underreact when management announces earnings as they have too much confidence in their own views. of the company's true value and tend to replace too little weight on a new information provided by management. If they have a new information, they think, no, okay, I'm confident on my view, the thing should be in this way. As a result, this new information, even though it is publicly and freely available, is not completely reflected in stock prices because we have different interpretations. The degree of efficiency of financial market is an important question and has generated extensive research. This is a very important area and a growing area in the field of financial markets. Historically, there has been some evidence of inefficiencies in the financial markets. This is summarized by 3 observations in table 4.7. Some value stocks outperform growth stocks. Momentum in stock returns. This is examine the momentum analysis and over and under reaction to corporate announcements. These are some studies summarizing the anomalies, whether the market is efficient or not efficient. If equity markets are inefficient, it means that investors can earn returns that are greater than the risk of their investments by taking advantages of mispricing, as I explained in the previous section. More recent evidence suggests that these patterns have largely disappeared after 2000s. Why it disappeared? Because the involvement of the financial institutions or the investor institutions, the involvement of the specialists who intervene in the markets and try to correct the mispricing. Looking forward, we can probably assume that the financial markets are pretty efficient, at least in the semi-strong form. In other words, market prices will reflect public information fairly accurately. At the end, just remind you with the key terms: arithmetic average, cash return, developed countries, efficient market hypothesis, emerging markets, equity, risk premium, expected return, rate of return, geometric, holding period, probability distribution, realized rate of return, risk-free, and semi-strong markets. Okay, this is the end of chapter 7, and on Saturday we will talk about chapter 8. Okay, thank you very much and take care. Assalamu alaikum.